Money, folks. Oh, that Realty income. We're going to talk about why I'm seriously contemplating on adding Realty income, ticker O, to my registered retirement savings plan. That RR to the S to the P for those Canadians that want some diversified U.S. real estate. Look no farther than, of course, Realty income, ticker O here with its whopping 5.6% yield. Consider hitting likes for those crazy high yields, baby, and subscribing if you're on your path to financial independence and perhaps one day retire early like I am, because we're going to be breaking down this stock today that so many of you have been asking about, which over a 5-year period is off its highs by 18%. But if you zoom out a little farther here, you'll see that's actually trading down over 30% from its recent peaks. And that is really presenting an interesting opportunity in the interest rate cut cycle, because I believe there's real potential for a massive recovery in this stock. Considering the yield is nuts, they're not going to cut the yield. They have a very refined and pronounced balance sheet. We're going to be reviewing all of this. So first and foremost, the reason I find this intriguing is the reason that I find a lot of dividend stocks intriguing, because when they're this kind of quality, this kind of fundamental balance sheet, and you see these yields start to spike, sometimes you can use the yield as kind of a sense to when the stock is in a good buying position, because typically these stocks don't get into these 5-6% ranges very often. And what's neat with Realty, if you zoom out through the entirety of their history going all the way back to the 90s, you can see basically through every single crash, the yield spiked up, and in 2008 as high as 9.4%, which I don't think we're ever going to get back to those kind of drops in the stock price, because we're not in a 2008-like situation. But you can see that the stock would later recover. I mean, the stock price is up here, and it's continually gone up. And you kind of got a low. I mean, back in 2019, the yield was as low as 3.2%. So we've seen basically a doubling of the dividend up to this point, and it is trading at levels that it really hasn't seen since pretty much 2008 here, guys. Like, we haven't seen yields on Realty like this in a very long time. So let's see if this is a true buying opportunity. We're not talking about dividend growth by any major extent. I mean, from 18 cents a decade ago to 26 today, it's nice that it is growing a little bit, but if I bought this back in 2019, I'd be heavily disappointed with the performance as of now, especially with the current offerings on the stock at its suppressed prices, right? And we take a look at the actual dividend scorecard here as well at 3.55% on a 5-year growth rate. Yeah, we're not really buying this for any excessive growth. We're buying this for cash flow today, reinvestable cash flow, right? And again, for real estate exposure, let's talk about it, because whoo, baby, like, I cannot find many comparable REITs that are going to give you this kind of damn diversity. It is quite astounding when you take a look here, right? Firstly, grocery stores make up 10%, 10.1%, convenience stores 9.5%. So 20% of your income is coming from convenience stores and grocery stores. But then you got dollar stores, home improvement, drug stores, restaurants, which thank God restaurants aren't that big of a deal, because I don't like restaurants as much as I like grocery stores for stability. Let's be real. Health and fitness, they're kind of coming back after the pandemic, which is good. Restaurants and casual dining and general merchandise, with 11.1% now being in the UK. They've recently been making a lot of investments in Europe. Texas at 10.5%, Florida, very diversified by geography. Their largest tenant is Dollar General at 3.4%. They got Walgreens in here, even FedEx, Wynn Resorts if you're into gambling. My God. CVS Pharmacy. Let's get into this, folks, because what I think is most intriguing here is that the overlap of the industries they have are highly differentiated. They don't overlap by any metrics. So if there are cyclical, experiences in the economy, like the pandemic, like the interest rate cycle, it's going to affect the ebb and flow of all these different businesses. But at the end of the day, that diversity is what's protecting you, right? And if we take a look at their European snapshot, which is also relatively intriguing here, again, now being a rather large piece of their portfolio, 10%. You got of that 10%, 46% are grocery stores, 17.9% home improvement. Sporting's good. I'm not a big fan of sporting stores, but again, other at 27.6%, with the top holdings being B&Q, ASDA, Sainsbury, a lot of these being grocery Encore stores. Now, if we dive a little bit deeper into the grocery store mix between, these two aspects of their portfolio between Europe and the US, it's nice to see that Walmart is actually 25% of their U.S. grocery store exposure, and it's great. They're even renting to the likes of Costco. How incredible that is. You got Amazon in here, and you take a look at Realty Income's top UK grocery stores clients here. You got Tesco, Sainsbury. I mean, they're just kind of representing that, hey, like, we have exposure to these incredible companies. We're leasing to them. It's Beautiful, beautiful stuff. So what I find most impressive is they break down the actual growth of the businesses themselves that they're getting these leases from, right? So if you take a look at convenience stores here, which is 9.5% of their ABR, I'm actually shocked at how well, these have been growing, because I don't like investing, especially in the Canadian counterparts like Alimentation Couche-Tard, which really has a lot of exposure to gas stations, because I don't think gas stations particularly are going to be the future as EVs continue to take over. And they have 9% margin on some gasoline, and they have 30% margin on in-store sales, just showing you how insane the markup is on, when you're buying things at gas stations. And there's 7-Eleven inside same-store sales. Look at this. 19 consecutive years of positive same-store growth. They're kind of like the low single digits here, but as of recently, they've been growing by 4.4% at peaks of 7.4%. So the growth has really come back in this industry. Look at dollar stores here. Again, very stable, but they had a little bit of a dip in 2021 and have recently been coming back. I think they've actually been doing exceptionally well as of recent. It doesn't look like this updates. I don't know if this updates into 2024, but dollar stores have been doing very well. Home improvement here. Another fascinating thing to look at, because you see the chart down here and it does not look great. I mean, obviously home improvement, interest rates, environment, people aren't taking as many loans out to, fix up their homes or do fix and flip. So that's been kind of deteriorating a little bit, but I'm sure like real estate is going to end up going to somewhat of a recovery at some point in the future here. And then drugstores have been crushing it. I mean, look at drugstores here. They've been in the high single digits to upwards of the teens, which is more like in line with tech companies. So drugstores, whoo, baby, crushing it. We don't even talk about guidance. Their guidance is coming in line with being very reasonable for the market environment, but we will talk more about the numbers here, because revenue growth, I gotta say, whoo, muy bien. In a market environment like this, how are we growing? How are we growing like this? This is a crazy good growth. I mean, we're talking about 20% growth tiles in revenue. This is unlike anything outside of tech companies for revenue. But what's killing them is the net income, right? At the end of the day, they have had zero net income growth on the back of some pretty incredible revenue growth, which all can equate to obviously the interest rates environment, higher, obviously interest expense. We'll take a look at that in a moment. And a lot of this probably isn't taking into consideration the depreciation or amortization costs as well. There'd probably be a bit more revenue growth if it wasn't for some of those expenditures. What kills me inside is the continual the shares outstanding they issue to continue to make these massive acquisitions, which has been better for cash flow. But in a market like this, where you're not getting net income growth, is what's primarily been hindering the stock. As of recently, they did do a pretty heavy dilution in the last earnings cycle. So lots to pay attention to from these metrics here. But let's talk about the balance sheet, because the company's got $68 billion in assets and $29 billion in total liabilities. One of the best balance sheets in the real estate business. Usually you see a 50-50 leverage. This is like below that, probably closer to 40%. Very, very great to see here. If we take a look at the revenue itself, again, growing dramatically from $944 million to $1.26 billion. Can't really complain on that. Depreciation costs are at $581 million. Obviously, that's a huge contributing factor that's not hitting the bottom line. So you got to put that into the net income to get a more. I wish they could make a chart that showed, excluding depreciation costs, what would the net income growth be. But if you take a look at interest expense here, it's gone up dramatically as well, from $154 million to $240 million just within a year. So that's obviously hurting them. But some of that does come with the growth of the business here as well. Everything I look at here is pretty reasonable, except again, when you take a look at obviously the funds from operation here have been deteriorating a little bit. And that wouldn't be deteriorating as bad if it wasn't for the depreciation and amortization costs. I'm not going to beat that drum any farther. I just think it's something you really have to pay attention to when it comes to REITs, right? But if we take a look, they raised $550 million from the sale of common stock, primarily through at the market program, at a weighted average price of $56.93, which I don't like to see here. That means that around $56 when the market was up a little bit, they're just pulling continual shares off the market, diluting you. I would have rather them just be a little bit more patient on the growth cycle and wait for the stock to recover, or at least start buying some shares back with, they do got some very reasonable free cash flow that's coming out of this. Nonetheless, like I said, there's a lot going on here, and I'm very much looking forward to seeing what this company does, because they made huge investments into casinos. They're looking at cloud computing centers. They're always on the forefront of what they think is going to have, some innovation into the future as well. And again, even if I don't like one aspect of their portfolio, there's another aspect that overclouds it dramatically. And considering it's a $47.9 billion asset, God, guys, I mean, you're getting it for a very reasonable value in today's market environment. And they just feel like these stocks are going to pop on their first interest rate cuts. So I might pick this up in my RSP here and contribute it with SCHD just to continue to get some diversification in the income that I'm getting, because it would get rid of the withholding tax, and I could lock in an easy 5.6 yield here on probably one of the best REITs the US has to offer. But I'll pass that off to you. Do you believe that? Are you buying something else? What do you think about it? Let me know in that comment section below.